In this video, I'll go from what trading is, how it works, to the different markets you can trade, how to place trades and actually read the chart, and get into a bit of technical analysis and how the market I trade personally, which is the futures market, works in depth, as well as then going to the strategy I use. So what is trading? Well, the main key points from it is you can buy and sell financial instruments for profit. So let's say you buy an asset at a certain price and the price increases and then you sell it. That price difference is your profit. That's how much you've made. And it's the same thing for price decreasing. Believe it or not, you can make money as price goes down. It's called shorting. So again, if you short, let's say high, and price goes down, it lowers, and then you buy it, or I guess close a trade at a lower price, again, that price change is your profit. And all of this is used in stocks, forex, commodities, futures, and crypto. So how does it work? Like, how does trading work? Well, price moves due to supply and demand. And if you already know what supply and demand is, like you have an economical understanding of what it is, then skip to this time. If not, then stay around, because I'll go into it, sort of, I guess. So supply and demand comes from basic economics. Price moves based on the relationship between how much of something is available, so this is supply, and how much people want it. This is demand. So supply represents the amount of a product, asset, or currency available. So in trading, supply zones are areas where sellers have previously been active, and demand is, well, it represents how much people want to buy. So in trading, demand zones are found where buyers have previously been active. And so the price, reaction to this is if there's more demand than supply, so people are buying it more, people want it more, prices are going to rise. And if supply is more than demand, so there's more of this asset than there is want, then price is going to fall. So again, like I said about the supply and demand, if there's more want for it, then price is going to move up. So people are going to buy more, and that pushes the price up. Referring back to this key point of as buyers, buy, price pushes up, and as sellers sell, price pushes down. And these trades are executed through brokers or exchanges. So a broker is a person or company that will put the trade onto the market. And they match basically buy and sell orders in real time. So let's say you have someone wanting to buy this asset and someone wanting to sell this asset. They'll pair them up together to get the best possible price for them. And this moves the price. And so these price charts display market activity, visually, so you can actually see what's going on instead of just numbers. So we go onto the type of markets. There's multiple different types of markets, as I said earlier. There is stocks and shares. So these are like ownership in companies. These are forex. Sorry, there are forex. So like currency pairs. And now this is the largest global market. This is literally, for example, when you go on vacation or holiday, however you want to call it. Let's say you want to change your pounds into euros, there's a set rate for that because the value is not the same. This is the forex um, market, and there's also commodities, so such as like gold, oil, silver, agricultural products like corn, stuff like that. There's a set price for them, and as I guess time goes on and weather and stuff like that, it affects the price of these. So you can also trade that. And then you also got crypto, which is a decentralized digital currency. Um, I don't know too much about crypto, to be honest. I don't personally like it, but some people do, and it's all up to them. And then there's also futures. Now, with futures, you have contracts. So futures and options, right? You have contracts to buy or sell at a set price in the future. So tradable for speculation. Futures is personally what I trade because it's similar to Forex, but instead of trading a currency pair, you trade an index or indice, um, such as the Nasdaq, the S&P 500, the Dow Jones. So that's what I personally trade. But each of these markets, they differ in volatility, liquidity, and trading hours. So most of these markets are open almost 24 hours a day. But the key differences between trading hours are, stocks, you can only trade them for a set amount of hours every Monday to Friday. Um, I don't know what the times are off the top of my head, but Forex is available 24/5, so it's open all day, Monday to Friday. Commodities, I think, are the same as Forex. Crypto are open 24/7, so you can trade them whenever you want. And futures is the same as Forex, but there's an hour where the market's closed, so you can trade it 23/5, so 23 hours a day, every Monday to Friday. Unless there's a bank holiday where, a certain market won't open. But yeah, you get a lot more volatility in centralized markets, I guess. So like futures is a centralized market. Everything happens in one place. Also liquidity. You know, every actually I'll explain what liquidity is. Liquidity is basically how much volume an asset has. So what this means basically is, how many people are trading it, how many orders are being placed. The more of it, the more liquidity it has. We call, I guess, sort of money, I guess, in sense, liquidity because of how much is being put in there. Now, again, I personally trade futures because that's what I like the most. Everyone's different, but I think personally it's the best market to get into uh, because of its risk to reward. So this is typically what your average, I guess, price diagram will show you. You have your, I guess, price. It moves up and down. But I'll go more into what this software is. This is TradingView, and this is by far the best charting software to use. You have loads of tools on here, as well as community tools, and these are called indicators. But before I dive into any of that, I want to show you what any of this means. So now I want to show you what a candle means. So this is something called a bullish candle. So what this means is a candle going up. So in short, bullish means up, and for down, that means bearish. So if we have a bearish candle, that means. So now what I want to go over is what a candle is, and what I'm showing here is a bullish candle. Now, what does what does bullish mean? Bullish just means up. So this is a candle going up, and the same with bearish. Bearish just means down. So if we had a red one, for example, that would mean price going down. So how does it actually work? Like what is any of this, right? Well, because it's bullish, we started down here. We started at the bottom and price went up and it closed up here. But we can also have scenarios where we have a wick, and a wick is just like a little line here. So imagine, you know, price started up, price started here, and we go up, we come back down a little, we go back up, we come back down, we go up all the way up top here, and we come back down. And this is where we close over your chosen time frame. So I'll go into time frames a little bit more in depth after I'm done with this, but this little stick at the top just means that price has gone up here and has came back down. Now it's the exact same for these red ones going down. This is just something I've made here just to sort of show what an average chart will look like. So we started here. Let's say this is the whole day. This is what's happened. So we started the day here and we closed the day up here. So what happened? We had price come up and then come back down. Oh, sorry, actually, I should show it like this. We had price come up all the way up here and then came back down here, and then we closed just there. So again, all of these sticks just mean this is where price has gone, and this body just means this is where it's opened and this is where it's closed. But the next candle, you see price closed here, the next candle opened here. Price came down, then we went all the way back up, and then came back down here to close. And we had this as well. We opened here, we went all the way up here, and then came back down here to close. Same thing here. We closed here, we opened here. Price came up here, and then came back down there, go back up a little, and then closed here. And then again, we opened here, came down, came all the way back up, and closed up there. So this is just how price moves. This is what's actually happening now. So this is what this shows. Now this is a lot more, this looks a lot more complex, but it's the exact same thing. So I have colors here. So my white is going up and my black is going down. This is just my preference. That's just what I like. So let's just take, I don't know, from here. This is the open. Now I'm not going to go through this whole chart. Blimey. So what happened here? We opened here, came all the way down, back up, closed here, opened, and so on. Exactly what I've just mentioned. Now, we can use all of this history as data. It gives us an insight to what's happened and what's likely to happen. So here, this is how, I guess, to place a trade. And I'm on Bitcoin here just because it is currently the weekend and the normal markets aren't opened, as I mentioned earlier. So let's just take a look here. We've had this massive, oh actually, before we get into any of that, I'll go over trends and how we can use this. So let's say up here, we're coming down, we're in a downtrend. Just because it means back up here doesn't mean that it's gonna go back up. So in a downtrend here, and then same thing here in an uptrend. So so a typical uptrend will look like this. Will look like that. And a typical downtrend will look like this. This is just sort of what price is doing, and just because it's coming back down doesn't mean it will continue going down. But you cannot say for certain that's what it's going to do. But let's say you have everything figured out. You want to enter a trade. You feel like price is going to go back up. So we want to buy. This is called a market buy order. And let's just set our stop loss here and our take profit here. Now, what does a take profit and a stop loss mean? And what does a market order mean? Well, a take profit and a stop loss is just a bracket which will take you out of the trade. So, if we have our take profit get hit up here, then the software will automatically take us out of that trade to get this profit. And if we hit the stop loss, it will automatically take us out and take this loss, just because you don't want to not have a stop loss and price continue going even lower to lose all your money. And same with price. And same with take profit. You don't want price to keep on going back up because eventually it will come back down. But I haven't talked about what orders are. So what we did was we did a market order. So this puts us in at whatever the next available seller price is. And this can vary depending on what time of day you were trading, as well as you also have some other orders. These orders are called limit orders and stop orders. Now, a stop order is basically just a stop loss. So if I was to remove this and I would put a stop, this is the exact same thing. If price comes back down to here, it will automatically take us out of the trade because we already have this trade. However, we can also use this to our advantage, to where if price eventually breaks out and you're not in a trade using a stop order, it will automatically put you in a trade, and if price continues in this direction, you'll be in profit. So like imagine here, if price comes down to here, you'll automatically be entered into a trade going down. And now I'll go over what a limit order is. So let's just get out of this trade. So let's say I want to sell here, but I don't want a market order. I want a set price. This is my price where I want to sell. I will go here and add a sell limit, and I'll wait for price to get up here. And we just wait for one of these to be hit. You'll see what happens. Let's say I want to sell limit then. So I want to sell, let's just say right here. And I put my sell limit there. Maybe I'll move it down. But I want to have my stop loss up here and my take profit here. Now you can see we're not in a trade right now. But as soon as we hit this price, just like that, now we're in the trade. And now we're just going to wait and see how this plays out. And see, that is what happens when we hit either a take profit or a stop loss. Alright, now there's one thing I haven't actually gone over just yet, and it's time frames. Now, you can see a lot of these time frames don't really look the same. As you can very much see. This is the weekly chart. So one candle represents every week. Daily just represents one candle is every day. The 4 hour, again, just represents every 4 hours. So price moves in this range every set amount of time. So in this particular case, the 4 hour. This is what price done in those 4 hours. Same with the 1 hour. Same with the 15 minute. Same with a 5 minute. Same with a 3 minute. And same with a 1 minute. Now, these time frames link up with each other. So, the daily corresponds with the 4 hour. So what this actually just means is price looks, I guess, similar. You know, you can tell very clearly what's happened, and this is just like in a shorter version of what's happened, or a longer version. Now, with the lower time frames, you get more data of what price has actually happened, but with the higher time frames, you get more idea of what price is going to happen. And so the 4 hour corresponds to the 15 minute, the 1 hour corresponds to the 5 minute, the 15 minute corresponds to the 1 minute, and the 1 minute corresponds to the 15 second. Now I want to go over the different types of traders. You have 4 different types of trading. You have scalp trading, which is like on the 1 minute to 15 second, you know, very, very short trades. They don't make a huge amount of money, but you make lots of them. You're in and out very quick within a couple of minutes. You have day trading, which is sort of the full term, I guess, intraday trading. So you're just trading within the day, you know, in and out maybe an hour, couple hours or so, maybe even less. You have swing trading, so these are done more on the higher time frames, where it could take a couple days, maybe even a week for your trade to play out. And then you have investing. Investing is like, I guess, buying shares of a company or holding an asset for time and stuff like that. Okay, so now I'm going to talk about something called PD arrays, or the full term price delivery arrays. And what this basically means is it's just price wanting to react off this. So one term is, for example, we have this, you know, period of, you know, price just moving sideways. We call this consolidation. You know, there's nothing really major happening here, but price swiftly moves down and creates this gap here. Now this is called a fair value gap because we had fair value here and now we have a gap, fair value gap. So let's just mark it. Now we can take this as an example where price wants to react off it. It has liquidity here. So, and what does price love? Price loves liquidity. So imagine we just took a trade off this. We had our stop up here. And we just targeted this low. Absolutely brilliant. This trade would have hit. But I will say this. You cannot enter of every single fair value gap or every single PD array, price delivery array. Because what we'll say here is that this PD array or fair value gap has been respected. However, if we take this fair value gap, this fair value gap has been disrespected. Now, fair value gaps and any sort of PD array are more probable to hit. When I say hit, I mean to be respected on a higher time frame rather than a lower. This is what I was mentioning earlier. Fair value gap is not just the only type of PD array. You also have things such as order blocks or liquidity, as in liquidity zones. Now, before I talk about order blocks or liquidity zones, I want to mention highs and lows. So we start here and we're in an uptrend. So we'll call this a lower low because the lowest low, and we go here and make a high. And we call this a lower high because we have this up here. It's lower than this high. And we come up here, we come down here and make this higher low because it's higher than this low. But it's still a low compared to what we had up here. We push a bit higher and make this higher high because it is higher than this high. So now I'll go over what an order block is. An order block is a block of orders. So typically found the candle before a big move. So I'm not going to call this here a big move, but a significant one. You know, price went up. So we'll call this an order block. It is the candle just before this move. And again, as you can see, price came down into it and then reacted off that. Now again, not every single order block is gonna be respected. Like this one here. As you can see, we reacted off it, it respected the order block at first, so we reacted, came back, tried to push higher, but came back down and disrespected it. So this is no longer valid. Now, I'll go over something called stop hunts as well. So this is when price manipulates. And all this means is big money players push price higher. They spend billions trying to get these people out. Now, I'm going to say this is technically wrong on how it works. However, for the simplicity of this video, this is what I'm going to say. So, at this high, we will have some orders resting here. Let's say some stops, I guess. Okay, people have entered off this downtrend, you know, like we said, sellers push the price down and they have their stop losses above this high or on this high. And we have this order block here because of a significant price drop. And we come here and price respected this order block. It came back down. However, price did come back up and you see this big long wick here. Compare it to all of the other wicks which has happened before to take out these stops up here. And then what did it do? Price dumped even lower. So in short, I have covered stop hunts, liquidity zones, order blocks, and fair value gaps. These are 4 different types of, actually no, 3 different types of PD arrays and one sort of, I guess, market mechanic on what can happen. So in recap now, we're just going to go over everything which I've talked about and specifically their key points. So trading is just the buying and selling of an asset for profit. Markets also vary in volatility, hour and structure, and the way which they work, as well as going over an understanding of candlesticks, orders, and PD arrays, as well as the market I personally trade futures and that's about it, to be honest. If you have any questions, just let me know in the comments, or you can join my Discord group and send me a DM directly if you have any personal questions about that.